Hello, I'm David Russell, VP of Content Strategy at TradeStation in Chicago. I'm a specialist in the US stock market with over 20 years of experience covering it as a journalist and analyst, and I'm here to help you trade it more effectively, no matter where you might be. Where any TradeStation affiliate is not authorized to do business, including to, but not limited to, Hong Kong and Japan. Active trading is not suitable for everyone. Options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information in the PDF handout available on the TradeStation website. Okay. All right. Well, it's great to be back with everybody. I'm very briefly showing the TradeStation platform. Now, TradeStation is a brokerage I work for here in Chicago. It is known for having just a lot of analytics and things like that. So I wanted to very quickly just look at some of the chart patterns and things that we're seeing overall. Now, as Daniel mentioned right here, there is actually a summary. If you go to the Monex site and you go up here to this thing called Insights right here, you'll actually find that we have an outline of the things that will be discussed on this webinar today. So we always like to start with the broader view of the market, the S&P 500. And as I look at things right now, the first webinar we came on, we were saying that, things were looking like a drop toward 2,800, 2,850 or 2,800, and boom, it happened. Then last week we had this big sell-off and we said things look like they were going to stabilize and have some bounce and have some upside. So both of those things panned out. Now as we take a look at what's really happening, let's go to the S&P here. And basically this is the longer term chart of the S&P 500. Now you can see there's a level here. 2,800 is not a level we just pulled out of thin air. This was a level way back over a year ago in March of 2018. And it was a level again here in June of 18. And then last year when the market was selling off, we had 3 tests there. I mean, just multiple price action in that 2,800 level. So in many ways, when you look at anything that's trending higher, people look for levels like that to be retested. The problem now is when you look at this is that there's not really, there's a saying in the United States, it might exist in Australia too. The saying is sell in May and go away. And, it sounds cute and a lot of people say it. There's a lot of debating over whether or not it's really a valid, sort of idea. The idea that is that in the United States, we basically have May, we have Memorial Day, which is the holiday this coming weekend. So it's going to be a holiday situation with lower volume and everything like that. So then people essentially summer kind of gets going, not exactly all the way at Memorial Day, but then you come to July and then things are really quiet for July and August. So the idea is that a lot of the big activity often happens in the first 4 months of the year and then basically after, in October, November, December period. But this period now of, May, June, July, August, now you're getting into a period of vacations and everything else. So that is an issue right now, I think, when you look at this. Now, the last 2 years, the S&P has moved higher after May. So, this is one of these things where it's not necessarily always right. But at the same time, there is a certain underlying logic behind this saying. And, I think it's worth revisiting that logic because in many ways, the question is when you think about it, the holiday coming up and then the idea that right now, I think everybody knows what's happening between President Trump and China. Those things right now, what is the horizon for those being resolved? And at this point in time, some of the things I've seen, we saw basically not only did the U.S. raise tariffs on China, but they also now turned around and slapped that restriction on Huawei, this giant, Chinese company. And then Google followed suit. And a lot of American companies have basically been following suit now. And instead of protesting like the way they often have in the past, they've actually kind of been going along with President Trump here. So this is something when I think you look at this, when you look at this situation, I'm not a political scientist, but I look at trends. And it looks to me that this whole trade war thing, the market refused to believe it for a long time. And now it almost looks like it's really going to be real. There's increasing consensus politically in the United States that the United States needs to do something about China. The Democrats believe it. I mean, China has very few defenders in the United States now politically. I mean, there's business people who don't want to do anything, but politically, there's a lot of things building. So my point in this is simply that, we could see things kind of increasing in terms of this situation. And then the question is, now let me be clear. you have to kind of look at the market and say, when we're down here, and the S&P has had this massive sell-off and you're back at Christmas, at that point in time, bad news doesn't matter as much because there's so much negativity that's priced in. But at this point in time, we're pretty close to the old highs. We see a lot of weakening overseas. We see a lot of this political risk, and we see what it means to companies like Apple that have been so instrumental and important to this market. This market has been led higher by large cap technology companies like Apple and Amazon, NVIDIA. These are large companies, Facebook, and all that sort of NASDAQ large cap technology. These will struggle. Even a company like Facebook that is not a big China play, at least, actually I'm not totally sure on that. But the key thing is these big technology companies, this is just going to weigh on them. And when you think of problems with something like Apple, when you think of the semiconductors, that will drag on all of the large technology, kind of regardless of whether or not it really makes sense. And I think that's important to realize now. And that just kind of weighs over the whole market. So I think right now, when you look at it, I want to show you something else. There's another thing I have on TradeStation, a little bit more complicated, but this essentially shows us the 1 month performance of different sectors. And we can see materials, energy, technology, industrials have all led the market to the downside. While then things like utilities have been among the better performers in the market over the last month. That kind of price action says that people are worried about risk. They are less willing to take risk and less willing to be optimistic. People are taking what we kind of say is a glass half empty sort of view. And, when you see all those things happening at the same time that, that we're entering a period when it's difficult for new events to really come out, with the holiday coming and then the summer coming, and the fact that President Xi already said, hey, we're not going to talk to Trump for a while. And then Trump basically they're pushing this, you know what I'm saying? This is not something now that is abating. So the key thing now is the S&P did not break out, and we come back down and we hold that first level at 2,800. But the thing is that we also have this 50-day moving average, which we're dying at. Now, there's something else that I think a lot of people, this is a level that I've been watching that I don't think, maybe not a lot of people have, but I think it's very interesting. When the market broke down in October, it came down here to 2,900 and it just consolidated for a few days and then it started knifing lower. This level right around here between 2,850 and 2,900, it's interesting to see that this level here, which came out to around 2,890 on the S&P, that was basically kind of a low from back here on April 18th. And then we have a double top under it. So right here, we have a line right around 2,890 that we've actually failed at, that actually has relevance at other parts along the chart. So I'm seeing things here that look to me like, it was almost inevitable that we were going to bounce at 2,800, and we did. But the question now is, we haven't broken out. And when you don't break out, one of the things you have to look out for is you have to look for the ranges that come into play. And that could mean deeper tests to the downside. And I don't want to say necessarily how low it would go. I don't even want to be excessively bearish. I think this is a very difficult environment right now, for looking at the overall index. I simply want to highlight that this is, there are a lot of positives, but when you look at the way things are going in terms of the calendar, in terms of the sector performance, in terms of the fact that, we failed to break out, all of those things, in my experience of analyzing the S&P, suggest that we actually could see people start to step in and push the downside. And I think that's something we have to be careful of. So let me go on now to it's interesting to look at some of these things that we actually saw coming out of China, because the thing to me is, or relating to China, American companies, it's one of those things where the impact of the China situation is far greater on large American companies than it is on the American economy. So, semiconductors, I want to actually show you something right here. This is the semiconductor index, SOX. The SOX, I'm sorry, it's SOX here, but this is now having its worst month. Now, in our first webinar, we pretty much said that this was something that we were concerned about happening, that semiconductors were going to be vulnerable to Chinese political risk, and this is exactly what's happened. Semiconductors are now having their worst month since the 2008 crash. So we're looking right now at just something pretty ugly. And the thing is, it's not even just China. I mean, the thing is, one day I was riding on the train and I saw like 5 men in a row, all with smartphones. I mean, everyone you look at has a smartphone. I think we all know this. It's a saturated market. People don't need another iPhone, at least not for now. So you have a saturated market. On top of that, you have the Chinese situation. And on top of that, you have this thing with Huawei, which is just, how do you even deal with that in terms of understanding what it means to these companies, which obviously Huawei buys a lot of these semiconductors from American semiconductor companies. So the semiconductor situation right now, this is a total trading instrument. If Trump tweets something positive about China, it's going to be good for chips most likely, and vice versa. So this is now a trading, vehicle essentially related to China. But it is important to realize that semiconductors got hit by this, and also this concern about things like the 5G. Now, if you look at the materials sector, that is, this is ETF in the United States called XLB. I'm going to jump over here to the Monex securities platform. I actually have a list set up. Now, these are the big American spider funds, which are basically the sector funds in the United States. And what we can see is how these guys are trading related to their overall 52-week highs and lows. And you can see now is things like materials are right in the middle of their 52-week high and low range. You look at things like energy. So all these things that have that sense of kind of risk on are very much struggling. Industrial stocks, a lot of these companies, you have companies that, they obviously sell things to China, or they also, are involved in things like agriculture, like Deere, which is a big tractor stock. All of that's gotten hurt because of grain prices coming down, again, because of China. And then also people are starting to worry about retail stocks because a lot of these companies buy their merchandise from China. And with tariffs and other things, all those things offer a threat to, potentially to their business models and to their profit margins. All these sectors now are areas where people are starting to get nervous about China. This week, for example, we have Target, we have Nordstrom's, we have Foot Locker, a bunch of American large retail stocks are reporting. So what I'm interested in is, I'm interested in knowing how much are people going to ignore the earnings per se and just say, well, what about China? What happens to your supply chain? What happens to your cost of goods sold? Are you going to get hit by tariffs? That, I think, is the big issue. And, the media has wanted to push this story. There's been this strong sense that the tariffs are going to be so devastating to American business. And it's hurt some companies. But when you look at overall, it hasn't really trickled through yet. That doesn't mean it will not. Because actually, when the tariffs first came out, American companies started buying more stuff from China to get ahead of the tariffs. So it could be something that simply has more of a delay. So at this point in time, this tariff thing is the main catalyst out there. And right now, people are simply scared of it. And it does seem like it's going to potentially get worse. However, at the same time, we have to you just kind of realize that this is a difficult environment for trading because you don't know what or when President Trump is going to say. You don't know what to make of it. He tends to have this tendency of trying to prop up the market. He'll say things are going great when they're really not. So, I mean, there's also questions now of even how much credibility will his tweets even keep having. It's just not what normal trading is. For most of us, we look at the market, we look at the economy, we look at companies, we look at earnings. We don't just look at basically two, global leaders somehow trying to outsmart each other going into negotiations. And that's kind of what we have. It's a very tricky backdrop. But the other thing that's interesting to me, and I want to go back quickly to the TradeStation platform for this, is the dollar index. I know the Aussie had a nice rally today, with the political news coming out of Australia. But if we look at the dollar index, which is, the strength of the US dollar, I mean, it's hard at this point, I think, to ignore the strength of the US dollar. And to me, this is something that emerging markets have really been struggling, as I'm sure you guys know, materials. And right now, I think the bigger thing we have to watch out for is we have to watch out for the potential of the US dollar actually starting to accelerate higher. It really has been in this very tight range. And I think right now, this could be also, something of a risk right now. So I think, this is one of the things I just want to highlight. If you look in the last, week or so, German ZOO, which is this sentiment index, missed estimates, You see the Chinese data last week. I was, mentioning that on the webinar, but then it came out weak. Russian GDP missed estimates. The Brazilian currency has been getting slammed recently. And then at the same time, it's interesting that the MSCI index people increased Chinese exposure in the emerging market indexes. So they're actually making China more important in the emerging markets at the very same time that this is happening. So all that is, to me, just something that argues against global equities at this point in time. So I think we need to just realize that we're looking at a period here of the U.S. dollar inching higher. And to me, the U.S. dollar does not actually reflect the the real situation right now. And my concern is what happens if it actually starts to express that real strength. So I wanted to just kind of mention that. Now, we do have some other companies that I wanted to mention that are kind of interesting. We go back and look at some of the different ones that we've mentioned on this webinar. On the first one, we mentioned Progressive, which has actually, done the best of them all. Snap has been an extremely volatile company that in many ways follows sentiment on the S&P. I'm sorry, the NASDAQ overall. It doesn't have anything to do with China, but again, it's one of those things where if Apple and some of the other big, NASDAQ stocks move, Snap is going to move with it. And then the small cap index has basically just drifted and dropped along with the broader market. Last week, we had mentioned Crown Castle, which pushed higher. And then today it fell on something which has nothing to do with much. I mean, it's basically there was a big merger between the American cell phone companies. It looks like it's going to go through. People see that as maybe putting a little bit of pressure on these towers. But these cell phone tower companies remain to be in a very interesting spot overall. And I wanted to just kind of mention that Honeywell and the home builders have kind of inched higher overall. So this week I want to look at I only had really two companies I wanted to mention, but this week one of them is Home Depot. Now, Home Depot, if anyone has been in the United States, you probably know Home Depot is a giant retailer. I don't think you have them in Australia, but they basically sell hardware, they sell lumber, they sell cabinets and things you put in your house. They are a huge company. They're in the Dow Jones Industrial Average. Now, if you look at this stock, let's look at it with moving averages. This company has had a big pullback to this level right around 190. Now, what's interesting about Home Depot is their earnings come out Tuesday morning in the United States, which is, 12 hours from now, 14 hours from now. So this evening, when you guys are done, you can take a look at Home Depot's earnings. But this is a company right now that has, there's going to be a little bit of China exposure. Some of the stuff they buy comes from China. But there has been some really remarkable news in the United States in terms of construction. And now, every month we get these retail sales numbers from the government. And the last week they were bad. But one area that was very strong was home improvement stores, as the category actually had growth. If you look in a lot of the construction numbers, not construction, but the labor numbers for American job growth, construction has been a strong part of the economy. So when you have people out there doing construction, it obviously has a pretty close tie to something like sales of lumber and products like Home Depot. If you go to Home Depot in the United States, it's contractors going in, they're buying stuff before they go and build a house or before they go and work on a house. And we've seen a clear increase in construction activity in the United States in the last few months. It's been in the numbers, and I've seen it anecdotally, to be honest. So it's interesting to see that. Here we have Home Depot. It has had had a really nice run, and then it pulled back to this 190 level. So this is an area where I think is interesting. A company like this is one of the more promising areas of the American economy right now, something like Home Depot. And so I did want to mention a name like this. Another one is a company called Five Below. This is also a retailer that is more on the lower end of the income scale. And what's interesting is there has been some real improvement at that part of the income scale in the United States. And if you look at this stock, it has just steadily trended higher, for the last year. And Goldman Sachs has been very bullish on them, and they tend to have a lot of influence. I just think it's interesting to look at a company like this that is still opening stores. A lot of retailers in the United States are closing stores. This company is still in a growth phase. So that's another interesting thing about Five Below. And I wanted to just mention the companies like this. They've often reported a lot of strong earnings history. And, this one also last time around, this was a big rally after earnings. Now it's pulled back to this level here, which is right around 130, which was a high back here last summer. It's a high again in February. Now it's holding that level. So for me, Five Below is another one that's interesting. It's in the right area, overall in retail. And the other thing is it's still a relatively small company, about $7-8 billion. So a company of that size is not, a company that size is still growing. It's not everywhere in the country. It can still get bigger. So that's, more kind of a growth story. So those are the main things I kind of wanted to talk about. Let me see if we have any questions. Does not look like we do. I just wanted to mention, just kind of highlight that this week now, so you guys are on Tuesday. It always is a little bit confusing for me with the calendar, or the times change. But you guys are starting your Tuesday. On our Wednesday in the afternoon, which would probably be very early on Thursday morning at like 1 a.m. or something for you, the Federal Reserve is going to have minutes. The minutes of its last meeting, the FOMC, is on Wednesday at 2 p.m. New York time. So that is something to watch, and it also ties into some of the things that I've been saying about the U.S. dollar. So I think the Federal Reserve they were trying to raise rates late last year. They've, I believe, been essentially stymied by the global situation. You have a lot of Asian central banks recently have been cutting interest rates and doing things like that. So right now, the Fed minutes, and then we go into the long holiday after that. So I just think it's important to realize these things. And then the following week is also very quiet. We have a revision to GDP, but even that at this point in time it's not clear right now how much anyone will really care that much about something like this. So we're simply in a spot right now where I think people have to realize that volume is going to kind of diminish, and at the same time, the potential for emotional sort of stuff is there. And the other problem is that large tech stocks and semiconductors, at this point, a lot of the narrative behind a company like Apple, Apple is a giant company, but at the same time, it can just be a total victim of what can happen right now in China. And that can have huge implications for tech and for the entire market. So it's a difficult environment right now. People might want to be shying away. I hadn't had a chance to really look into them, but I did want to mention that the American defense companies, there's companies that are military contractors. They make missiles and weapon systems and things like that. They've started to push higher. Now, I haven't had time to and none of them had very good setups as well, which is why I did not really want to mention them. But if you guys want to look at them on your own, these are the sort of companies that are probably going to be interesting and worth looking, kind of getting a sense of, because a lot of these companies are, they're not sensitive to the economy, and at the same time, they, excuse me, at the same time, they're not sensitive to the economy, and we have the situation happening with Iran. So it is interesting to just kind of look at some of those companies. Like I said, I don't want to mention them because I haven't had a chance to really research them, but there are 3 or 4 very prominent companies that do military contracting in the United States that have started to push higher, and they very well could be worth kind of investigating some more on your part. The last thing I wanted to mention was that another company, I'm going to jump back very xickly to TradeStation because it does suggest that just a little bit of people thinking that things, maybe being oversold or whatever in the technology space. This company is called Xilinx. They do semiconductors, and they had a lot of Chinese exposure, and they obviously took a beating because of that. Now this company had a huge rally, into April. The last earnings report was like so-so, which is another reason why you have to be careful, with earnings, because their earnings beat estimates, and people said, hey, it was only good, it wasn't awesome, so we're going to destroy the stock, and they did. Then on top of that, you have this whole China thing, and the stock took a total beating, XLNX. What's interesting is somebody stepped in today, and they sold a lot of puts. Now, I just wanted to mention this, options trading and something stuff is not something we want to really, get into too much in terms of, suggesting it or offering it as an opportunity at this time. But the thing is that somebody was betting that this stock will hold the $90 level. So that's something that's just kind of interesting. Now, again, that's 10 points below where it is now. Doesn't say that it's bullish by any stretch of the imagination, but it does kind of show that at this point in time, people are starting to kind of, look for some of those opportunities. But again, it's interesting to look at that because they're not buying the stock, they're selling the options, which means that they just think it's going to consolidate and sit. It's not a good buy in their view. It's simply something where they think it's going to start to stabilize, and they're looking at a level like 90. Now, this was a great stock last year. So maybe it's something where, people watch it at a level like 90. I just wanted to kind of mention that because now, in my view, is a time we want to be thinking about looking for good stocks to get cheaper. If we are going to be in a situation where things are bearish or have the risk of getting worse, we want to be looking for some of those good companies that could do well. And, I continue to look at some of these names like these wireless tower companies and things like that. At the end of the day, those are an area that, they have just a lot of interesting growth that is still built into them. So those are the main things I really wanted to touch on today. This is the last of this set of webinars. We'll be doing some more again down the road. But if anyone has any questions, wanted to just give you an opportunity. And don't forget now on this insights page, a lot of my posts from time to time will appear. This is something I wrote about some of these wireless companies. And then we also look at how earnings have been doing in different companies. We were talking about some of the situation with the trade war. In fact, in this post right here, I actually kind of highlight how there has been this sense. In fact, I have a podcast you can see on YouTube here as well. But there's been this kind of growing consensus in the United States that is kind of supporting Trump in this trade war sort of thing. So I think it's important just to kind of, have a sense of those different things that are happening. I try to avoid politics, but when it matters for trading, then we want to watch it. So those are the main things I want to discuss. And it's been great talking to everyone. And looks like we have no questions. So I'm going to wrap this up. And, down the road, we'll see you guys again. Don't forget about some of the offers that Monex has now. In fact, Dan, what are the offers that you guys are now making available to people who sign up and fund an account for Monex Australia?
Yeah, thanks for that, David. So right now we've currently got a free brokerage promotion for all of our international markets. So if you weren't already a client with our platform, you can trade the US market along with 11 other markets focused around Asia. So shares in Hong Kong, Japan, China, even smaller market like Thailand, the Philippines, or Indonesia. You got access to all that. And until the end of July, there's actually free brokerage for all new clients there, or all clients in total there. So have a go for it, guys. And yeah, if you were looking to trade Home Depot or Five Below or any of these other stocks, yeah, feel free to check out the platform. We do one-on-one training sessions as well. So if you are new to investing, we can kind of hold your hand and show you how it all works. And yeah, thanks a lot, David, for participating in the webinar series. This will be the last one for the next few months. But if you were looking to get more insights from David through his articles or just trading ideas in general, we send a newsletter to our clients on a weekly basis with about 3 to 4 different articles with good insights there. So thanks again, everyone, and thank you, David.
Thanks, guys.